Okay. Selamat sejahtera, Professor Dr. Imna and fellow colleagues. We are Group 3. My name is Ishwari and my group members are Mogari, Nevin and Vidya. Today, I will present the financial analysis of two major players in the glove manufacturing industry. That is Hartalega Holdings Berhad and Top Glove Corporation Berhad. I'll be starting our presentation by providing an introduction to both companies. First, next slide. First, let's begin with Hartalega Holdings Berhad. We have categorized as Company A in our analysis. This company begins in 1988 under Mr. Kwan Kamhon and has grown into a leading manufacturer of net-trill gloves. Globally, it exports products to over 70 countries, serving healthcare, dental, life science, food, and industrial sectors. Listed on Bursa Malaysia since 2008. On product, it focused on glove innovation, including net-trill glove, antimicrobial gloves, and skin-friendly coatings. Next, we move on the Top Glove Corporation Berhad, which we have categorized as the leader company in our analysis. Founded in 1991 by Tan Sri Dr. Lim Wee Chai and Tong Swee Bee in Malaysia, it rapidly became the world's largest glove manufacturer by 2004. Has manufacturing facilities in Thailand, China, and Vietnam, and marketing office in key regions like the US, Germany, and Brazil, serving over 2,000 customers in more than 195 countries. Listed on Bursa Malaysia in 2001 and had a secondary listing on Singapore Exchange in 2016. On product beyond manufacturing gloves, it includes items such as face, mask, dental dam, and exercise band. Next slide. On the trend, okay, we will explain the trend analysis for Hartalega from 2002 to 2003 and the peer analysis for both company for the year 2024. Let me start with liquidity ratio. On the liquidity ratio, we have two categories. That is, one is current ratio and quick ratio. Current ratio is current assets over current liability. Current ratio of Hartalega shows very strong liquidity across all years. 2023 is the highest at 6.67, meaning they had RM 6.67 in current asset for every RM 1 ringgit of current liability. These constantly high ratios suggest Hartalega has a very comfortable position in covering its short-term debts. Top Glove 2024 has a lower but still acceptable ratio, that is 1.91, still above the benchmark of 1.0. So they can cover short-term debts but not as strong as Hartalega. Okay, let me talk about quick ratio. Quick ratio is this gives a clear picture of company's ability to meet its immediate obligation without relying on the sales of the inventory. Okay, quick ratio is the current asset minus inventory over current liability. Hartalega shows a strong ability to meet short-term obligations without needing to sell inventory. 2023 remains the peak year with 6.01. Top Glove 2024 has a lower quick ratio, that is 1.52, which means its cash and receivables are enough to cover liability, but the margin is narrower. Next. Okay, next I will explain on asset management ratio. Asset management ratio is which illustrate how efficiently a company is utilizing its asset to generate sales. First, I will talk about the inventory turnover ratio. Inventory turnover ratio is a cost of sales over inventory. Okay, Hartalega. In 2022, the company sold and replaced its inventory 8 times a year, stronger turnover. In 2023, even more efficient, faster inventory movement, that is 9 times. In 2024, significant drop. Inventory is now turning over only 4 times per year, meaning that products are staying longer before being sold. On the other hand, Top Glove in 2024 performs better than Hartalega in 2024, that is 6 times. Inventory turns 6 times, meaning faster movement of stock, may suggest better sales performance or inventory control. Okay, on asset management ratio will be continued by Mogari.
Okay, my name is Mogari and I'm going to explain about the DSO. In this slide, shows the daily sales outstanding, which is DSO, which measure how long it takes for a company to collect payment from its customer. For Hartalega in 2022, DSO was only 19 days, indicating fast and efficient collection. In 2023, DSO increased to 49 days, likely due to weaker demand or relaxed credit terms. In 2024, DSO further to 77 days, meaning collection now take over 2.5 months. This could hurt cash flow. For Top Glove in 2024, DSO is 52 days, better than Hartalega, which is 77 days. This suggests Top Glove has a stronger credit management and faster collection. Next. Okay, in this slide, I will explain about the fixed asset turnover ratio, which shows how efficiently a company use its fixed asset to generate sales. For Hartalega in 2022, the ratio was 2.50 times, meaning every RM1 in fixed asset generated 2.5 RM2 ringgit and 50 cent in sales, a very efficient use. However, the ratio dropped to 0.82 in 2023 and 0.62 in 2024, showing reduced efficiency, possibly due to lower demand or underutilized asset. For top glove in 2024, the ratio is 0.43 times lower than Hartalega. This indicates even weaker efficiency in using fixed asset, possibly from idle machinery or decreased sales. Next. Okay, here in this slide, I'm going to present the trend and peer analysis for the asset management ratio, focusing on the total asset turnover ratio. This ratio shows how efficiently company use its asset to generate sales. The formula is simple: sales dividend by total asset. Let's look at Hartalega first. In 2022, the ratio was 1.24 times, meaning every RM1 ringgit of asset generated 1 ringgit and 24 cents in sales. That's very efficient. But in 2023, the ratio dropped sharply to 0.45 times and then to 0.35 times in 2024. This shows that the company is using its asset less efficiently, maybe due to lower sales or excess capacity. Now, for top glove in 2024, the ratio is 0.36 times, slightly better than Hartalega, but it's still quite low, showing underutilized asset. This may be due to weak sales or industry-wide challenges like overproduction or inventory build-up. So for both companies have been declined inefficiently, and it suggests that they are not fully utilizing their asset to generate sales. Next, we move to slide number 9. Okay, in this slide, we can see about the debt to invest capital ratio, and the formula used is total debt divided by total invest capital and divide times by 100. Okay, let's look for Hartalega. In 2022, the ratio was 3.17%, which means only a small part of its capital came from debt. In 2023, it increased to 3.21%, but dropped again to 1.51% in 2024. This shows Hartalega is reducing its dependence on debt over time. Now, to top glove in 2024, the ratio is just 0.07%, meaning the company is almost fully financed by equity with very minimal debt. So, in conclusion, both companies are maintaining very low financial risk. Hartalega is reducing its debt year by year, and Top Glove is already operating with almost no debt at all. So that's all from me, and next will be presented by Nevin.
Okay, hello everyone, I'm Nevin. Okay, now I'm going to present about the time interest earned TIE ratio. So TIE ratio is EBIT, earning before interest and tax, over interest expenses. Hartalega since 2022 to 2023 had strong interest coverage with TIE ratio of 43 and 33 times, showing low risk financial risk. In 2024, Hartalega TIE dropped to 6 times, indicate weaker earning or higher debt burden. Top Glove on 2024 had the lowest TIE at 3 times, showing higher financial risk and limited ability to cover interest expenses. Next, I'm going to present about the profitability ratio. So under profitability ratio, one of the ratio that we calculate is operating ratio, which is EBIT over sales times by 100. In 2023, Hartalega recorded the highest operating ratio at 10.32%, indicating strong profitability relative to sales. In 2022, Hartalega and in 2024, Hartalega had a similar ratio around 2.6% and 2.5%, showing stable but lower operation efficiency. 2024, Top Glove had the lowest ratio at 0.85%, reflecting weak earning generation from sales. Hartalega showed the best performance in 2023. In conclusion, both Hartalega and Top Glove experienced significant drop in 2024, especially Top Glove, indicating reduced operational efficiency and possible cost pressure or revenue decline. Next, I'm going to present about the profit margin ratio. Profit margin ratio is net income over sales times by 100. In 2022, Hartalega had an exceptionally high profit margin of 41.1%, indicating strong net income and excellent cost control. In 2023, the margin dropped to 9.91%, still healthy, but reflects a significant decrease in profitability. By 2024, Hartalega margin plunged to 1.8%, showing a drastically decline in earnings from sales. In 2024, Top Glove recorded a very weak margin of 0.02%, almost breaking even, indicating extremely low profitability. Hartalega saw a sharp decline in profit margin over 3 years, highlighting challenges in maintaining the net profitability. In conclusion, Top Glove margin in 2024 was nearly zero, suggesting cost pressure or declining demand. Then I'm going to present about the basic earning ratio, which is EBIT by total asset times by 100. In 2023, Hartalega achieved the highest BEP at 4.69%, showing the most efficiency asset utilization among all years and companies. In 2024, Hartalega dropped sharply to 0.88%, reflecting weakening operating performance despite similar asset levels. For 2024, Hartalega had a BEP of 3.26%, indicating solid performance, but slightly lower asset efficiency than in 2023. By 2024, Top Glove recorded the lowest BEP at 0.45%, indicating poor return from its large asset base. In conclusion, Top Glove lower BEP suggests it is struggling to turn asset into operating profit, which may impact overall financial strength. So now I'm going to present about the return of asset, which is net income over total asset times by 100. In 2022, Hartalega had an especially high ROA of 51.08%, showing excellent profitability and asset efficiency. In 2023, Hartalega ROA dropped sharply to 4.5%, indicating a major decline in earning relative to asset. By 2024, Hartalega ROA plunged to just 0.38%, reflecting very weak profitability. In 2024, Top Glove posts a low ROA of 0.665%, also suggesting inefficient asset utilization and poor return. Top Glove also had a low ROA in 2024, but pointing to weak income generation from its asset base. Both companies faced the profitability and efficiency concerns in 2024. In conclusion, Hartalega ROA show a dramatic decline over 3 years, from very strong in 2022 to minimal in 2024. Then I'm going to explain about the return of equity, which is net income over total common equity times by 100. 2024, Hartalega recorded a very high ROE of 63.31%, indicating excellent return to shareholders and strong profitability. In 2023, Hartalega ROE dropped to 5.15%, reflecting a sharp decline in performance. By 2024, ROE fell further to just 0.43%, suggesting the company is barely generating return on shareholders' fund. By 2024, Top Glove showed a low ROE of 0.78%, also indicating poor shareholder return and weak net income. In 2024, Hartalega recorded a very high ROE of 63.31%, indicating excellent return to shareholders and strong profitability. In 2023, Hartalega ROE dropped to 5.15%, reflecting a sharp decline in performance. By 2024, ROE fell further to just 0.43%, suggesting the company is barely generating return on shareholder fund. In conclusion, 2024 Top Glove showed a low ROE of 0.78% and also indicating poor shareholder return and weak net income. Next, Nitya are going to present about the market ratio.
Hi, market ratio is about the price earning ratio, PE, price divided by earning per share. So from 2022, from 2024, Hartalega and Top Glove face valuation issue due to changing profit. Hartalega had high earning in 2022 as ringgit Malaysia 94 ringgit 63 cent, but a very low price earning ratio of 0.02%. In 2023, it had a loss as negative ringgit Malaysia 6 ringgit 88 cent, making its price earning ratio of 0.27%. By 2024, Hartalega earning slightly recovered as ringgit Malaysia 0.3 cent, 30 cent, and price earning ratio 7.43 cent, showing improved investor confidence. So Top Glove at a higher in 2024 as Ringgit Malaysia 0.80 cent, but a very low price earning ratio of 1.15%, reflecting a weak market stress. Overall, Hartalega show a modest recovery while top loss maintained under pressure. Next. So market ratio, price earning PE, so book value over price value and times by 100. From 2022 to 2024, Hartalega market book ratio rise from 1.26% to 2.03%, showing increased investor confidence despite weak profit. In contrast, top loss market book ratio was 1.26% in 2024, indicating moderate but question market sentiment. Overall, Hartalega showed improving market outlook, while top loss maintained stable. Next. Dupen equation. Return on equity equals profit margin times total asset turnover times equity multiplier. So in 2022, Hartalega higher ROE 63.20% was driven by strong profitability and efficiency. By 2023 to 2024, its ROE declined sharply due to reduced margin and asset turnover. Top Glove also showed weak performance in 2024 with low ROE 0.456% from poor profitability and efficiency. Both companies faced significant decline in performance. Thanks. So, trend and peer analysis key finding. Trend analysis Hartalega. From 2022 to 2024, Hartalega maintained strong liquidity but faced a sharp decline in profitability. ROE dropped from 63.31% to 0.43% with weakness margin or efficiency. Despite lower debts and leverage, earning and interest coverage fell significantly. Market ratio slightly improved in 2024, yet overall performance declined. Peer comparison, Top Glove. In 2024, Hartalega showed strong liquidity and interest coverage than Top Glove, indicating better short-term stability, while both at low profitability, Top Glove at a slightly higher ROE. However, Hartalega maintained a more efficient capital structure and strong market valuation, reflecting a more favorable overall financial position. Financial health. Hartalega's strong liquidity, conservative debt strategy are positive, but the continued decline in profitability, asset turnover, and earning powers signal concern about efficiency and long-term sustainability. Improve needed store financial strength. So recommendation to improve performance, Hartalega should enhance operation efficiency, control costs, and refine pricing to regain profitability. Growth can be driven by market expansion and new product, supported by moderate low-risk debt. Strengthening receivable and transparent long-term strategies will help restore investor confidence. Thank you.